Gold has historically been regarded as money, and this concept remains relevant today. When you trade a dollar for items like gum or groceries, you are not merely exchanging a piece of paper. Rather, you are trading a representation of gold or silver value embedded in that dollar for the goods and services you desire. This understanding is anchored in the monetary regression principle, which asserts that our comprehension of current prices is rooted in our knowledge of past prices. Without this historical context, prices would lack meaning and become arbitrary, undermining the division of goods and services essential for a functioning economy. The role of money is to facilitate this division based on supply and demand, which is crucial for maintaining an organized economic system. To grasp the origins of the dollar, one might consider its evolution from a silver standard to a gold standard, reflecting a transfer of wealth from the middle class, who primarily held silver, to the affluent, who possessed gold. Initially, barter systems relied on the exchange of goods, with silver emerging as the most widely accepted medium of exchange, followed by gold. Thus, even today, when you use a dollar, you are effectively trading a highly inflated representation of gold. The fragility of this illusion becomes evident during economic crises, such as the one in 1933, when the government adjusted the gold exchange rate from $21 to $35, signaling a recognition that the previous valuation was unsustainable, leading to significant economic turmoil. The true cost of gold extends beyond its monetary value. It raises the question of what the price would be if every individual on Earth decided to convert all their dollars into gold simultaneously. This scenario leads us to consider an exchange rate rather than a simple price, which would likely need to be set around $35,000 to $40,000 per ounce to satisfy the demand from those seeking gold. The price we observe on futures exchanges reflects the industrial demand for gold, which is not universal, as not everyone requires gold for industrial applications. However, the need for gold as a monetary asset is widespread, with many treating their dollars as if they were gold. Historical patterns suggest that we may be approaching a significant economic shift, reminiscent of past crises, though the exact nature of this transition remains uncertain. Economists like Ludwig von Mises have described this phenomenon as a crack-up boom, where the economy appears to thrive due to increased fiat currency circulation, creating an illusion of wealth as GDP rises. However, GDP merely reflects the money supply, and this situation can lead to hyperinflation, where the velocity of money increases dramatically. As the public's desire to hold cash diminishes, individuals may find themselves willing to spend any amount of currency just to rid themselves of it, resulting in a chaotic economic environment. The impending crack-up boom signifies a critical juncture in the financial landscape, where the distinctions between central bank digital currencies, traditional paper money, and other forms of fiat currency become irrelevant. The core issue lies in the erosion of privacy that accompanies the rise of digital currencies, yet fundamentally, they all represent the same flawed monetary system. As this system approaches its inevitable collapse, the consequences will be felt universally, reminiscent of the hyperinflationary crises experienced in countries like Venezuela and Zimbabwe, but on a global scale. Historical precedents such as the ability to purchase a mansion in Berlin for a mere handful of gold coins during the Weimar Republic suggest that those who possess physical gold will emerge as significant beneficiaries, accumulating substantial real assets as the purchasing power of precious metals skyrockets. In the initial chaos of this breakdown, reliance on tangible assets will be paramount, as trust in all forms of currency will disintegrate. Rather than a collective awakening to the principles of sound money or a sudden interest in Austrian economics, the reality will mirror the behavior seen in previous market bubbles. Individuals will flock to gold and silver not out of a deep understanding of monetary theory, but simply because their values are rising, driven by the recognition that we are approaching the end game of the current financial system. In an effort to pursue physical assets, individuals will likely seek to acquire as much tangible gold and silver as possible, leading to a surge in demand for delivery services. This situation will create a frantic environment where dealers may find themselves unable to meet supply demands, resulting in widespread panic. Consequently, the prices of physical gold and silver are expected to plummet as global interest intensifies. The book, The Theory of Money and Credit by Ludwig von Mises suggests a return to the use of physical coins for transactions. While this may not be a permanent shift, during the initial turmoil characterized by skyrocketing prices and collapsing bonds, people will likely prefer coins over any other form of payment for goods and services. However, there is no need to hoard vast quantities of these coins, as this situation is not expected to last indefinitely. Eventually, alternatives will emerge, with some entities offering to securely store gold and silver in exchange for more reliable substitutes. This evolution will foster a competitive currency market, where dishonest currencies will fail while trustworthy ones will thrive. A free market in money is the anticipated outcome. It is crucial to ensure that you are investing in physical gold or silver, as financial instruments like ETFs will not provide the necessary security in a crisis. Even if a provider like Sprott is deemed more reliable, in a scenario where everyone demands their physical assets simultaneously, the reality of receiving those assets may become complicated. It's unlikely to materialize, and while I acknowledge the existence of the asset, I firmly believe you won't be able to acquire it. What good is paper gold if the dollar loses its purchasing power? GLD can serve a purpose for those looking to speculate on gold prices, and I engage in that practice myself, albeit with a modest investment. However, if your goal is to actually purchase gold, GLD is not the right vehicle, nor are alternatives like PHYS or any offerings from Sprott. When it comes to gold mining stocks, the situation is somewhat different. ETFs, which are essentially collections of shares, present a lower risk of misrepresentation regarding their holdings. The real concern lies in the fate of mining shares during a potential economic collapse. I advocate for holding mining stocks because, in the event of a currency failure, which I believe is inevitable, gold and silver mining companies will likely be among the few that can provide genuine dividends backed by their product. This means they will have the financial resources to issue real dividends, possibly even in the form of certificates that you can redeem for gold. In contrast, with ETFs, which are often controlled by banks, I have serious doubts about their reliability in such a scenario. While speculating on gold prices through ETFs is an option, I do not recommend it for long-term security in an endgame situation.